Welcome to The Explainer. Today, we're going to dig into the investment story behind a really fascinating company in the medical robotics space, PROCEPT BioRobotics. We're going to walk through the bull case, the bear case, and see what the source material concludes about its future.
Okay, so first things first, what problem are they even trying to solve? We're talking about something called benign prostatic hyperplasia, or BPH. Yeah, it's a mouthful, but the condition itself is incredibly common. It affects millions and millions of men, which means there's a huge market just waiting for better solutions.
So what's PROCEPT's big idea? Well, it's not just another pill or some traditional surgery. Nope. It's this groundbreaking robotic system they call aquablation therapy. Basically, it uses an AI-guided, heat-free water jet for treatment. That's a really big deal because it promises a level of precision and consistency that's a major leap forward.
So what's the core argument for being bullish on this company? Why are people excited? Well, it pretty much comes down to one thing, just explosive growth. Let's take a look at the evidence.
And here's your first piece of evidence. I mean, look at this number. It's staggering. In a recent quarter, their revenue shot up a massive 43% compared to the year before. This isn't some slow and steady kind of thing. This is a company that's clearly in the middle of some seriously rapid market adoption.
Now, here's where it gets really interesting when you break down where that money's coming from. This reveals their whole razor and blade model. You see, while selling the big robotic systems is great, the recurring revenue from the consumables, the handpieces and other things you have to keep buying, that now makes up 2/3 of the business, and it's growing even faster. That is a beautiful, predictable revenue stream for any company.
And to fuel all this growth, well, the company has built what you could basically call a fortress balance sheet. It is sitting on nearly $300 million in cash and equivalents. That gives them a ton of flexibility to make moves.
And this slide just illustrates their financial strength perfectly. You've got that massive cash pile on one side, and on the other, a very manageable $52 million in long-term debt. What this really means is they have a multi-year runway to fund their expansion without having to go out and borrow more money.
But you know, it's not just about the numbers. The company has also built a really strong competitive moat. Their Hydros system is the only AI-powered platform for this kind of therapy, which lets them offer personalized treatment plans that doctors love. It also creates a natural replacement cycle for older systems, and to top it off, it's all supported by a secure US-based supply chain.
Okay, so that all sounds pretty great, right? But it's not the whole story. Let's flip the coin and look at the other side of the argument, the bear case. This is all about the real-world hurdles standing in the way of profitability.
And the first major hurdle is cash burn. Despite all that amazing growth, the company is still burning through cash, about $80 million over the last year. That's because they're investing a ton of money into their sales force and into R&D to stay ahead of the curve.
And all that spending means that, for now, its return on invested capital is actually negative. The source material makes a great point, comparing it to more mature, highly profitable companies in the space like Intuitive Surgical, the makers of the Da Vinci system. PROCEPT just isn't there yet.
Skeptics point to what they call a pre-mortem scenario, which is a really smart way to think about risk. As this table shows, it lays out what could go wrong. For example, what if hospitals have to tighten their budgets? Well, that could slow down sales. Or what if there's a big shift in the market? Any of these things could seriously impact the stock.
So we have this classic story of high growth versus significant risk. It's a real tug of war. So the big question is, what does the market think this whole story is worth right now? And this is where the story gets really interesting. Despite all that positive momentum and all that growth, the stock price has been hanging out near the bottom of its recent range, and that creates a major disconnect. I mean, just look at this gap. It's dramatic. The current price is hovering around $27, but Wall Street analysts, they think it could go all the way up to around $51. That's a potential upside of over 80%. And it's not just wishful thinking. The company actually has some pretty significant tailwinds that could help close that valuation gap. You've got new legislation that helps with R&D spending, a new reimbursement code that's going to improve Medicare coverage, and the fact that it's a US-based company insulates it from a lot of geopolitical drama.
Okay, let's pull all of this together for the final analysis from the source material. When you weigh all the pros and all the cons, what does it all mean? The source ultimately gives this a conviction score of 7 out of 10. And the conclusion is really key. It says that because of the current low valuation, the risk/reward balance now skews attractive. In other words, the potential upside seems to outweigh those execution hurdles we talked about.
So if we boil it all down,
The crucial point is this. PROCEPT has a really unique AI-driven technology and the strong financial footing to back it up. But, and this is a big but, that journey to consistent profitability still has some very real challenges that any investor needs to keep a close eye on.
And that leaves us with the central question, one that really sums up this entire debate. Is PROCEPT BioRobotics a truly revolutionary company that's just about to turn the corner on profits? Or is it a classic growth story that might just end up stumbling on the hurdles ahead? The answer to that is likely going to define its next chapter.